I'm here with Scot Thompson, co-head of systematic investments at Macquarie Asset Management. Scott, welcome to the Inside Network's Income and Defensive Symposium 2024.
Thank you. Nice to be here.
So many investors look to achieve growth through equities and to balance that performance against some fixed income and alternative solutions. Could you explain the rationale for allocating capital into defensive equities, please, Scott?
Well, growth is important, right? Every portfolio needs some level of growth, and equities is a fantastic opportunity. It's liquid and it's available. And the important thing is actually the allocation to that asset class rather than the asset class itself, if from an overall return perspective. So matching your portfolio with the objective of your clients.
How do you think about building a defensive equities portfolio?
So I think there are two things about equities. One is the volatility of the total market. There's three things really. The second one is the volatility of the style of the manager. And then the third one is the volatility of the outcome of the manager. So if we assume that the first bucket, which is the asset volatility, that's a known, right? We build our portfolios using asset allocation models on a equity basis. If we then break that down into style, whether it be value or growth, each one of those will actually differ from that asset allocation decision. So I'm immediately putting in some risk, and some of that risk is rewarded or may not be rewarded and fits in with your investment process, but you have to be conscious of the fact that there's risk. And then the way that the investor actually manages is going to add additional risk to that as well. So they're going to have tracking error on the sector or their style, which then goes on top of your asset allocations. It all builds up. So the way that we think about it is actually, do you get rewarded for the style exposure? We don't believe you do. So we believe that you actually want to have exposure to all styles. So you remove that additional risk there layer. And what we're actually saying is give that risk to the manager to get you the best mix of stocks out of that whole portfolio. It's really about trying to remove some of those big, potentially unrewarded biases in the portfolio.
Okay, so managing those three pillars of
That's right.
variability. Would advisors be correct in assuming that there is a correlation between defensive qualities of the level of yield they can generate compared with growth equities?
It's a good question. I think we're seeing as interest rates go back to normal levels, you're starting to see less dominance of the equity income payoff. During the very, very low zero interest rate period, everybody had to look for either very high yield to very high risk fixed income assets, or they went to equities. But the challenge in equities and in income space is that it becomes very sector specific. So you've got REITs, you've got banks, you have healthcare that are all throwing off quite good yield or quite good dividends, but then you've got this sector exposure that doesn't necessarily help from the overall return, so the total return perspective.
And where do advisors typically place this sort of solution? In which kind of portfolio sleeve would you put it? Does it sit in equities or as a replacement for other defensive positions?
It should. So that a systematic approach or a core portfolio, which gives consistency of exposure and hopefully consistency of return, should be one of the building blocks of your underlying fund. So you've got a foundational investment in equities with a nice alpha stream that comes off the top of that. From there, if you need to, you can allocate some of your fee budget to some of the very high active share strategies if that's where you would like to go to meet your clients' needs.
It probably goes without saying, Scott, that there are a lot of moving parts and variabilities in the current macro and geopolitical landscape. Why might now, in 2024, be a good time for advisors to think about allocating to defensive equities?
I think that's the $64,000 question, right? So being able to time asset classes, your asset class decisions, is really, really hard, right? And some people get it, some people don't. And I believe personally that a lot of that is luck. It's not necessarily understanding exactly when these big levers are going to change. Nobody really picked the GFC. Nobody really picked the impact of COVID. Nobody really picked the fact that Russia was going to invade Ukraine. But being prepared for that is really important. So irrespective of where you think the market's going, that core portfolio has to be ready for any of those regime changes. So if the market style changes, you have exposure within that core portfolio all the time.
Wise words indeed. Scot Thompson, thanks for joining us.
Thank you. Appreciate it.